Into Friday, currencies are mostly higher against the US dollar on the week, with the yen standing out as the strongest since the weekly open, up about 1.3%. Gold has managed to just outpace the yen, coming on strong in Thursday trade as the rout in equity markets continued. One of the interesting things about the price action this week is that it has been triggered by an exodus from stocks as investors feel the heat of higher interest rates in the US. This is interesting because higher rates should be viewed as more dollar bullish, and yet the dollar has been sold. But this can be reconciled by the fact that the currency market had already done a good job in 2018 pricing in Fed normalization and higher rates. The stock market, on the other hand, had chosen to do nothing at all until there was actual pain. And so we've been seeing one market that has already reacted to the big yield differential move, and now perhaps too much, while the other is only just trying to play catch up. As far as currencies go, we say too much because there are some mitigating factors to the recent run in the US dollar. The first has a lot to do with a major theme in markets this year, which has been the theme of US trade policy and its impact on the balance of the global economy. The US administration is pushing a policy that is inviting of a weaker US dollar, and following an initial wave of retaliatory efforts from its trading partners, which had the market running into the dollar, we see these efforts pushing on from the US administration and ultimately playing a part in dictating direction in the currency market, with the dollar selling back off. The second reason is because of what we're seeing right now. While we don't expect the Fed will be moving the other way to the point where it satisfies equity investors as it had done so many times over the past decade, we believe that there could be enough of a reining in of what has been a more hawkish leaning bias that it would force the currency market to make some adjustments the other way, which is to say the Fed could ease up a bit with its rate hike timeline, which will drive yield differentials back out of the dollar's favor. Overall, we believe the current backdrop in which the equity market may see a period of extended declines to undergo a correction long overdue, the major currencies will be in a position to outperform while risk-correlated FX lags. We also believe the euro and pound could outperform the yen and Swiss franc, considering the well-known policies in Japan and Switzerland, with both the BOJ and SNB unwelcoming of inflows that would have their currencies appreciating too much. And as far as picking between the euro and pound goes, we actually see the pound as the currency that may end up outperforming all others over the medium to longer term once the Brexit bumps are behind us. This is because all of the other currencies are in the game of battling out for the weakest currency in order to retain competitive advantage in their export economies. But the UK doesn't fall into this group historically, and the UK economy has proven to operate quite well over time with a stronger currency. Couple this with the pound trying to recover out from plus 30-year lows, and we don't think this is to be such a far-fetched idea. Looking at the calendar today, German CPI, Eurozone industrial production, and US Michigan confidence are the notable standouts. That's all for now.